Welcome back to the Deep Dive. Today we are jumping straight into the world of high-stakes, distressed European real estate.
And specifically Italy. We're looking at how international capital gets access to billions in assets that Italian banks are trying to get off their books.
Exactly. We're talking about non-performing loans, unlikely to pay positions, and repossessed real estate. You know, the NPLs, UTPs, and REOs.
It's a huge market.
It is. But this isn't just about finding an undervalued building. This is a deep dive into the financial engineering, the legal and tax architecture that you need to make these opportunities work for, say, global pension funds.
It has to be digestible for them and safe.
Right. And you provided us with some really specific sources that detail these intricate fund structures used in Luxembourg, the SCSp, the RAIF variants, that basically govern these massive investments.
They're the playbook.
So our mission today is pretty clear. We are giving you a shortcut to understanding these institutional mechanics. The core idea from the sources is that, yes, Italian distressed assets offer incredible potential, often double-digit gross IRR.
Which is a huge number.
A huge number. But that yield is only available if you can solve the puzzle of governance, tax efficiency, and regulatory clarity. And that solution, it seems, is Luxembourg.
It is. That's where the magic happens.
Okay, let's unpack this.
That potential return is absolutely the magnet, but you're right, it's tied to some very real, on-the-ground operational complexity in Italy.
I can imagine.
You have Italian banks and servicers constantly disposing of these assets, so the pipeline is there, it's robust. But if you're, say, a U.S. or an Asian institutional investor, you can't just go and buy a portfolio of loans directly.
You need a wrapper, a trusted international wrapper.
Exactly. The goal is always to maximize your risk-adjusted returns, but you have to do it with strict governance discipline. The capital has to flow in and out efficiently, and your exit routes have to be crystal clear.
Which can be a challenge in some European jurisdictions.
Yeah.
So that brings us to Luxembourg. We know it's a default for a lot of funds, but what makes it so perfect for Italian distressed assets specifically?
It's really the combination of flexibility and, I'd say, institutional acceptance. The sources call it the neutral, flexible, and institutionally acceptable platform.
And it's deeply compatible with AIFMD, right? The Alternative Investment Fund Managers Directive.
That's the key. If you want to raise serious money from major European professional investors, AIFMD compliance is just non-negotiable.
So it unlocks that capital pool.
It does. And beyond that, Luxembourg has this tested toolbox of vehicles, as the sources put it. It lets managers pick a structure that's tailored not just to hold the assets, but to actively manage the risk, the tax, and even the sponsor's own incentives.
Okay, so the structure itself is the critical bridge here. And the sources really emphasize that the choice of vehicle changes everything.
It determines your whole strategy.
All right, let's dive into those structures.
Yeah.
We've got four main options here, and we can think of them as a spectrum, right? From the most simple and tax transparent up to the most formal corporate structure.
Exactly. And the foundation, the starting point, is the SCSP, the Société en Commandite Spéciale.
Okay, what is that in simple terms?
Think of it as a contractual limited partnership. But the crucial thing is that it does not have its own legal personality.
And what does that lack of legal personality get you, commercially speaking?
It makes it tax transparent by default, and that is absolutely critical for certain investors like U.S. taxable investors or family offices.
Because they have their own tax treaties they can use.
Precisely. They don't want another layer of corporate tax created by the fund itself. So the SCSP is perfect for smaller, very focused club deals.
Give me an example.
Imagine a small group of investors buying an 80 to 120 million euro portfolio of secured NPLs. Maybe they're all backed by logistics properties in Lombardy. For that kind of focused deal, the SCSP's simplicity is perfect.
Okay, that makes sense for concentrated capital. But distressed real estate is often a game of scale and specialization. You need to run multiple strategies at once without the risks bleeding into each other.
Which means you need something more complex.
And that brings us to the next tool, the SCSp SICAV-RAIF.
Right. So first, we have to talk about the RAIF, the Reserved Alternative Investment Fund. Now, it's AIFMD compliant. It follows all the rules. But here's the kicker. It is not directly supervised by the CSSF, which is Luxembourg's main regulator.
Okay, wait. Why is avoiding direct supervision an advantage? That sounds, less secure on the surface.
It's a trade-off for speed and flexibility. The RAIF has to appoint an external, authorized AIFM and alternative investment fund manager, which is supervised. So the regulatory oversight happens at the manager level, not the fund level.
I see. So the fund itself can be set up much faster.
Much faster. And speed to market is everything when you're pricing these kinds of assets.
So you combine the SCSp partnership with the SICAV, the variable capital structure, and you get this umbrella structure.
Yes, with multiple compartments. And that compartmentalization is the secret weapon for scaling up. It gives you absolute risk ring fencing.
So you could have a Lombardy MPL's compartment and a Lazio UTP-backed offices compartment.
And investors in Compartment 1 are completely insulated from any legal or commercial risk that happens in Compartment 2. It's essential if you're building a big pan-Italian platform, maybe aiming for 400 to 600 million euros in commitments.
Okay. Now, what happens if we add a corporate element to this? That gets us to the SCSp the Partnership Limited by Shares.
This is a crucial distinction, especially for the sponsor, the fund manager.
Why do they love this one so much?
Because the SCA is a hybrid. It mixes corporate liability protection with partnership economics. It allows for a really clean, visible separation between the management share classes, where the carried interest is, and the investor share classes.
So it formalizes the sponsor's skin in the game.
It really does. For a sponsor doing complex repositioning, where they expect a big payoff in 5 to 7 years, this structure shows a very strong alignment of interests. The equity upside is right there at the fund level.
And that's perfect for those big club deals, like acquiring and repositioning non-core office assets in Milan or Rome, which takes us to the far end of the spectrum, the big gun. The SCSp the classic joint stock company.
This is the wrapper you choose when you need the absolute highest degree of corporate governance formality.
So your investor base here is
predominantly institutional. Giant insurance groups, large pension funds, sovereign wealth. They often have internal rules that they prefer corporate vehicles over partnerships. The SA gives them that familiar framework.
The sources also mentioned it's better if you're thinking about a potential listing. Why is that?
It just provides a much cleaner, more standardized legal framework that stock exchanges understand. It's the simplest path if listing is on your roadmap. You often see these RAIFs used for huge pan-European funds, maybe €1 billion plus, where the Italian distress strategy is just one sleeve within that larger structure.
Here's where it gets really interesting.
It is, because the choice of wrapper becomes less about a legal preference and more about mitigating specific operational risks inside Italy itself.
Let's anchor this in the regional deal flow then, because the sources show that Italian geography really dictates the structure.
It absolutely does.
So let's start in the north. Lombardy, Veneto, Emilia-Romagna. This is where you find the highest concentration of debt tied to solid assets, right? Logistics, industrial offices.
Exactly. And enforcement of that debt is generally seen as faster and more predictable there. So scalability is the name of the game.
What do you mean?
An SCSp SICAV-RAIF compartment makes perfect sense. The assets are standardized enough, think warehouses along the A1 motorway, that you need to scale up fast. And the ring fencing ensures that if one NPL gets stuck in a local court, it doesn't drag down the whole fund's value.
But on a smaller scale.
If you have a standalone SCSp buying, say, an owner-occupied industrial portfolio for a sale and leaseback, the investors just want that clean, tax-transparent pass-through. They aren't trying to build a €500 million platform.
Okay, let's move central. Lazio, Tuscany.
Yeah.
The assets get more complex. City center offices, heritage hotels.
And the friction points are much higher. Repositioning a Grade B office in Rome might involve 5 to 7 years of navigating local regulations. You need patient capital.
And a very aligned sponsor.
Which is why you see the SCSp-RAIF used here. That structure is built for sponsor-led complex value creation. It signals to investors that the manager is in it for the long haul.
And for something simpler there, like turning around a few boutique hotels near Florence.
Again, a simple SCSp is often preferred by a small group of family offices. Low setup cost, tax transparency, it just fits the deal.
Finally, the south and the islands. Campania, Sicily, Sardinia. Higher perceived risk, but also potentially compelling yields.
Yes, and that higher risk perception makes structural protection critical. If you're acquiring residential blocks in Naples, for example, that risk makes an SCSp SICAV-RAIF compartment almost essential.
You're using the structure as a shield, the most aggressive form of ring fencing to insulate the rest of your portfolio.
It's a governance tool masquerading as a legal structure. A perfect example of how the financial wrapper is a direct response to the underlying Italian legal risk.
Which brings us to the part that really separates the pros from everyone else. The architecture of governance, risk, and of course, tax. This is how you make sure the high yield doesn't just leak out.
Right. Governance is the non-negotiable layer here, and that starts with the AIFM. The AIFM takes on the primary portfolio and risk management duties. It's expensive to set up, but it's the key that unlocks all that institutional European capital.
And the general partner.
The GP, which is owned by the sponsor, implements the investment strategy, but they operate strictly within the rules of the partnership agreement and under the AIFM's oversight. It's a system of checks and balances.
And what about the service providers? The sources highlighted the role of the depositary with Italian assets.
The depositary and administrator are vital. They're not just checking bank accounts. For Italian PLs, the depositary is doing forensic work on the title, the security interests like the Italian ipoteca, the mortgages, and the valuations.
They're making sure the complex Italian paperwork actually lines up with the fund's documents in Luxembourg.
Perfectly. It's a critical control.
And what about risk controls within the structure itself?
Well, the AIFM enforces strict leverage limits at the compartment level, so you're not over-leveraging a risky asset. And crucially, concentration limits aren't just by asset type, they're by Italian province.
So you don't get overexposed to the judicial system or market of one single region.
Exactly. And another huge piece is servicer selection and KPIs. The key metric isn't just recovery rate, it's time to enforcement. How quickly can your local Italian partner navigate the courts? That's where they earn their fees.
Okay, let's hit the tax layer. Because for anyone focused on yield, this is where it all comes together. How do these structures stop profits from leaking out on the way back to the investor?
This is probably the most complex part. With the tax-transparent SCSP, it's simple. Income flows through, investors use their own tax treaties. Easy enough.
But with the corporate ones?
With the corporate RAIFs, the SEA or the SA, the fund itself generally pays an annual subscription tax on its net assets, not a corporate income tax. That's a huge benefit.
But the real friction is in Italy, isn't it? The local Italian SPVs that actually own the properties and the loans.
That's where the real battle is. Those local Italian SPVs pay Italian corporate tax, but the main problem the Luxembourg structure solves is managing the withholding tax, the WHT on payments flowing from Italy back up to the fund.
And if that's not structured perfectly?
That WHT can be very high, and it can just eat away at your double-digit IRR. The whole point of these Luxembourg vehicles, especially when they qualify under EU directives, is to reduce or even eliminate that withholding tax. That efficient cash repatriation is maybe the single most valuable thing these wrappers do.
So what does this all mean when you're picking a structure? It's a tactical choice. So what does this all mean?
It means you have to match the vehicle to your strategy and your investors perfectly. If you're a small club looking for tax transparency and low cost, you choose the SCSp RAIF.
Simple enough.
If you're a manager who needs to build a scalable platform and compartmentalize risk across different assets, the SCSp SICAV-RAIF is your workhorse.
And if you're a sponsor with a complex, long-term repositioning play where you need to show that strong alignment of interests,
you opt for the SCA SICAV-RAIF. And finally, for the giant pools of institutional capital that demand that corporate formality and maybe want a path to listing, it's the SA SICAV-RAIF.
it's such a powerful example of how financial engineering is really just a trust framework. And the big commercial advantage here isn't just about managing complexity, it's the ability to scale. You can go from a focused €100 million club deal to a multi-compartment €1 billion platform, all within a predictable and regulated system.
Absolutely. And these structures are complex for a reason. It's because the Italian opportunity itself is complex. It requires very specific local knowledge. When an investment committee looks at one of these proposals, they're really asking 3 core questions that sum up everything we've talked about.
Okay, what are they?
First, is the Italian distressed asset pipeline, the NPLs and UTPs, actually big enough and liquid enough to justify the cost and effort of a multi-year dedicated vehicle like this?
Right. Is the opportunity worth the complexity?
Second, does our proposed Luxembourg structure perfectly align with the specific tax, governance, and regulatory needs of our investors? Specifically, can it efficiently manage that Italian withholding tax?
A repatriation question.
And finally, and this is the most critical one, is the sponsor's platform on the ground in Italy actually capable of executing? Can they manage the complex local restructuring and servicing needed to get these assets performing again across all the different regions?
So it's that combination of high-yield local execution with robust international standards.
That's the foundation for success. It's the meeting point of continental European law and high finance.